Imagine waking up to a letter from the IRS. You know, that envelope with the Treasury Department seal. For a lot of people, that's a pretty chilling thought. It kind of brings on this jolt of anxiety, right? It makes you think about every financial move you've made. But what exactly happens when the taxman, comes knocking? Is it just random? Like bad luck? Or is there actually a method to it all? And maybe more importantly, how can you navigate this whole complex system? Not just to, survive it, but to really understand your rights and, well, protect your financial peace of mind. Today, we're doing a deep dive into the, let's say, intricate world of federal tax procedures. We'll cover everything from that first hint of an audit all the way through navigating the courts and, yeah, understanding the penalties if things go wrong. It's really about being informed, not intimidated.
That's a perfect way to put it. Because at its heart, our tax system works on self-assessment. We voluntarily report our income, figure out what we owe, and then, pay our taxes. So this deep dive is all about the procedures, the checks and balances the IRS has to make sure people actually comply, and crucially, what rights and options you have as a taxpayer if you end up in a dispute. We'll unpack the audit process, the appeal system, which people often misunderstand, the different courts you might end up in, and, yeah, a full look at the penalties, and importantly, how you might be able to avoid them in the first place.
Okay, so let's start with that core idea. Self-assessment. We file, we pay. It sounds, well, kind of based on trust, doesn't it? But if it's all voluntary, how does the IRS actually make sure everyone's playing by the rules? How do they enforce that voluntary part?
Right. That's exactly where the audit process comes in. It's a really crucial mechanism. It's how they verify that people, and businesses too, are accurately reporting their income and paying what they actually owe. You can think of it as the system's integrity check. It's vital. Because without audits, that voluntary aspect, well, it could easily break down. You'd risk widespread noncompliance. And that would undermine the whole tax system, potentially shifting the burden onto people who are paying honestly. Audits are basically designed to keep things fair, make sure everyone pays their share according to the law.
Okay, so it's the systems check. How does the IRS decide who gets audited then? Who gets put under that microscope? Is it just, bad luck, like winning the worst lottery ever? Or are there specific things that flag your return?
It's definitely not just random luck, though I suppose a tiny element might feel like that sometimes. It's mostly rooted in very specific, data-driven things. So while, yeah, bad luck could play a tiny part, it's usually much more targeted. The IRS uses some pretty sophisticated methods these days to pick out returns that are most likely to have errors or, let's say, discrepancies. First off, they use these complex statistical models. The main one is called the Discriminant Inventory Function System, DIF for short. These DIF models are basically very advanced algorithms. They analyze tax returns using tons of historical data. They look for patterns, and they flag returns that have characteristics most likely to have errors. Or, from the IRS point of view, returns that might lead to significant extra tax money if they audit them. Think of it like a really advanced pattern recognition system, combing through millions of returns, looking for anomalies, things that don't quite fit the usual profile for someone with your income or your type of business.
That sounds incredibly analytical. Is there a downside for the taxpayer, though? Like, could a perfectly correct return get flagged just because it looks weird statistically? And how would you even defend against that, against an algorithm?
That's a really sharp question. And yes, it's absolutely possible. A perfectly legitimate return could get flagged. Maybe you had unusually high but totally legitimate medical expenses one year, or a big one-time capital gain. That might make your return look statistically off. The defense, though, is the same as for any audit: meticulous records. Good record keeping. The DIF score just gets you looked at. Your documents are what prove your case. Now, while those statistical models are the main thing, a very small percentage of returns are also picked manually and randomly. But it's not just arbitrary. It actually serves a purpose for the IRS. It helps them get data on a wider range of returns, even ones that wouldn't normally get a high DIF score. And that data helps them keep their algorithms tuned up, basically. Keeps their models accurate over time. It's kind of like quality control for their selection process. And here's something really important for taxpayers to know. If you were audited before, say, in the last couple of years, and that audit found you owed a lot more tax, a substantial deficiency, well, your returns in the following years are much more likely to be audited again. It's like a follow-up. They see a potential pattern of errors or maybe aggressive tax positions, and they want to keep an eye on it.
Wow, that's a crucial point. So it's not just about fixing one mistake. It's like the IRS build a risk profile for you. The real takeaway there is that being careful isn't just a one-time thing. Getting audited once can make you, like, a regular on their radar. That definitely changes how you should think about future filings.
Precisely. Then there's another huge trigger. Information return discrepancies. This is all about data matching. The IRS gets millions and millions of forms from third parties. Your employer sends a W-2, your bank sends a 1099 for interest, brokers send 1099s for stock sales, and so on. If the income or deductions or credits reported on those forms don't match up exactly with what you put on your tax return.
Oh, okay. That makes sense.
Yeah, or if the IRS gets info from somewhere else about potential noncompliance, that mismatch can automatically trigger an audit, or at least an inquiry. Like if your W-2 says you earned $70,000, but you only reported $60,000, that's almost certainly going to get flagged. So making sure everything matches up is absolutely critical. And finally, deductions. If your itemized deductions are way higher than the average for your income level and family size, that can raise a red flag too. Now, it doesn't automatically mean you did anything wrong. You might just have legitimate high expenses, big medical bills, lots of charity donations, high mortgage interest, whatever. But it does mean they might want to take a closer look, especially if your numbers are far outside the statistical norms for people in your bracket. They'll want you to substantiate those claims.
Right. So if you are taking big deductions, just make sure you have the paperwork, all the proof. That seems to be a constant theme with taxes, doesn't it? Which brings up timing. Once you file a return, how long does the IRS actually have to audit it? Do we need to keep boxes of records forever? Or is there a point where we can finally shred things?
Great question. And no, definitely not forever. Thank goodness. Most individual returns, if they're going to be audited, it happens within 2 years of filing. But legally, the IRS generally has until the statute of limitations runs out. Typically, that's 3 years.
3 years from filing.
3 years from the date you filed the return, or the due date of the return, whichever is later. Now, that 3-year period can sometimes be extended if the taxpayer agrees to it. That often happens with complex cases, to give everyone more time to sort things out without immediately going to court. Interestingly, for really big corporations, because their finances are so complex, they often face audits pretty much every year. It's almost continuous for them.
Okay, so hold on to records for at least 3 years, maybe longer if it was a complicated year, or definitely if you agreed to an extension. Now, if you are selected for an audit, what does it actually look like? Are we talking, formal meeting, back room, bright lights, or is it sometimes simpler?
It really varies, depends on how complex the issues are and what kind of return it is. The IRS has different levels of examination, kind of escalating in intensity. The most common type and the least intrusive is a correspondence audit. Often, this is just a review for mathematical errors or simple mismatches. Think of it like this. Maybe you typed a number wrong, or used an incorrect Social Security number, forgot to sign it. Or maybe the income on your return doesn't quite match a W-2 or 1099. Simple stuff. Usually you'll just get a letter in the mail explaining the issue. It's often easily fixed by sending back a document or a quick explanation.
So no meeting needed.
Right, typically no formal meeting. It's all done by mail. You'll get a revised calculation, maybe a bill if you owe more, or maybe even a refund check. And if you pay promptly after getting a notice like that, interest usually doesn't build up from the date of the notice. So it's often the quickest and simplest way things get resolved.
Okay, so sometimes it's just a minor clerical thing, not a deep dive into your whole life. That's probably a relief for a lot of people. What about when it gets more involved?
Right, then you might face a formal examination, specifically an office audit. This is definitely more involved. It's conducted by an IRS revenue agent, usually at an IRS office, though sometimes parts of it might still be handled by mail or phone. This is pretty common for individual returns that don't have complicated business income. The main goal here is usually for you to substantiate, basically prove with documents a specific item, like income or deduction or a credit you claimed. They'll ask you to bring in the supporting paperwork, like receipts for business expenses or records for charitable donations. And then there's the most extensive type, a formal examination that's a field audit. This is where an IRS representative actually comes to you, to your home or your business office or maybe your accountant's office. The IRS decides the where, when, and how for these.
So they come to your turf.
Yeah, potentially. These are usually reserved for more complex situations, maybe complicated individual returns, self-employed folks with significant business activity, or larger businesses. And a key thing to know here. You have the right to make an audio recording of the interview during a field audit. That can be really important for your records, especially if disagreements pop up later.
Okay, so the audit itself is finished. You've handed over the documents, answered the questions. What happens next? Does it just end? Or are there more steps?
Well, ideally, it's resolved right there. If you and the revenue agent actually agree on the changes they're proposing, maybe you owe more tax, maybe you even get a refund, you'll sign something called Form 870. The official name is Waiver of Restrictions on Assessment and Collection of Deficiency in Tax. Bit of a mouthful.
Form 870. Got it.
Signing that is a pretty big step. It means you agree to the changes. And the good news is interest on any extra tax you owe stops building up 30 days after you file that form. Then you'll either get a bill for the tax and interest or a refund check plus interest on the refund.
Okay, Form 870 sounds like a quick way to wrap things up. But what's the catch? Is it always the best move? Are you giving anything up by signing it?
There is a trade-off, yes. It definitely offers a quick resolution, but by signing Form 870, you waive some important rights. You give up your right to get certain official notices from the IRS later, and, crucially, you give up your right to take your case to the U.S. tax court.
So you can't fight it later in tax court if you sign.
Exactly. You also waive your right to the administrative appeal process within the IRS itself. Now, signing Form 870 usually closes the case for good, but technically the IRS could still come back and assess more tax if they find something really significant later, like fraud they didn't know about. It's rare, but possible. So yeah, it offers finality, but you do lose those appeal rights.
But what if you just fundamentally disagree? You're sure the agent is wrong, or you just can't reach an agreement you're comfortable with? You definitely wouldn't sign that Form 870 then, so what happens?
Right. If you don't reach an agreement with the revenue agent, the process moves up a level. You'll get a copy of the agent's report explaining their findings, and you'll get what's called a 30-day letter. This letter is basically a preliminary notice. It tells you about your right to appeal their decision within the IRS's own administrative system. You then have 30 days from the date of that letter to formally ask for an administrative appeal with an IRS appeals officer. This is your first formal chance to argue your case above the agent level, and there's a valuable option here, especially for small businesses and self-employed people. It's called fast-track remediation. This is designed to speed things up, aiming for a resolution within about 60 days. You get a trained mediator from the IRS Office of Appeals who tries to help you and the revenue agent find common ground.
A mediator. Interesting.
Yeah. It's not available for every single type of issue, though. Like, if there's no clear legal precedent or courts disagree on the issue, fast track might not work. But if it doesn't resolve things, you can still go through the regular, longer appeals process afterwards.
Fast-track remediation sounds good for speed. But are there downsides, like situations where maybe taking the slower, traditional appeal route might actually be better strategically, even if it takes longer?
That's a very smart question. Yes, there can be trade-offs. With fast track, because it's quick, you might have less time to pull together extra evidence or really build out complex legal arguments. Efficiency is the goal. The traditional appeals process, while longer, gives you more breathing room, more time to prepare, maybe consult experts, refine your arguments. And the traditional appeals officer often has a bit more leeway to consider the hazards of litigation, basically, the risk that the IRS might lose if the case goes to court. That can sometimes lead to a better settlement in really complex cases. So yeah, it's a strategic call. Depends on how complex your case is and how ready you are.
Okay, so let's say you decide to appeal, whether it's the regular way or after fast track. What's the main goal of this appeals conference? Is it like another audit or something different?
It's definitely different. The IRS Office of Appeals isn't there to re-audit you. Their primary mission is to resolve tax disputes without going to court. They act as a sort of independent arbiter within the IRS. They try to find a resolution based on the facts, the law, and importantly, those hazards of litigation we mentioned.
Hazards of litigation, meaning their chances of winning in court.
Exactly. They weigh the strengths and weaknesses of both sides' cases and consider the potential costs and uncertainty of a court battle. This often allows for more flexibility in reaching a settlement compared to the audit level. If you do reach an agreement with the appeals division, you sign a different form, Form 870 AD. This settlement is generally considered binding on both you and the IRS. And again, interest stops accruing once the form is received and accepted.
But what if even the appeals conference doesn't work out?
Yeah.
Or what if someone just missed the deadline to appeal the 30-day letter? Is that the end? Game over.
Not quite the end, but this is where things get serious, and the clock really starts ticking loudly. If appeals fail, or you didn't appeal the 30-day letter, the IRS issues the 90-day letter. Its official name is a Notice of Deficiency. This letter is critical. It's the IRS's final administrative determination. It tells you the exact amount of tax they believe you owe. And you have exactly 90 days from the date that letter was mailed, not received, but mailed, to do one of two things. Either you pay the deficiency in full, or, and this is crucial, you file a petition with the U.S. tax court.
The tax court, that's the specialized one.
That's the one. Filing that petition is your ticket into the judicial system without having to pay the disputed tax first. If you miss that 90-day deadline, your options to fight the tax before paying shrink dramatically. And it's really important to understand the difference here. If you want to take your case to a U.S. District Court or the U.S. Court of Federal Claims instead, you must pay the tax deficiency first. Then you file a claim for a refund with the IRS. If they deny it, then you can sue them for the refund in one of those courts. The U.S. Tax Court is the only court where you can fight the IRS before paying the disputed amount. That's a huge strategic advantage for many taxpayers who might not have the funds readily available.
Okay, so if all the internal IRS processes fail the audit, the appeal, and you still think they're wrong, the next step is court. What does that look like? How is the federal court system set up for these kinds of tax fights? Who actually decides?
Right, the federal courts are the final decision makers, and either you or the IRS can initiate this step. The system is basically structured in levels. You have the trial courts first. That's where cases are initially heard, facts are presented and decided, and the first ruling is made. Then you have the appellate courts. They review the decisions made by the trial courts, mostly to make sure the law was applied correctly. For tax cases, the main trial courts are the U.S. Tax Court, the U.S. District Courts, and the U.S. Court of Federal Claims.
3 different options at the trial level.
3 main options, yes. That's where the initial battle happens. Above them are the appellate courts. The U.S. Courts of Appeals, often called circuit courts, the Federal Circuit Court of Appeals, and right at the top, the U.S. Supreme Court. Appellate courts usually don't reevaluate the facts found by the trial court. Their job is mainly about legal interpretation. Did the lower court apply the right law in the right way?
Before we dive into each court, are there any big, overarching legal ideas that are really important to grasp when you're heading into a tax court case? Things that might shape your strategy.
Absolutely. There are a couple of fundamental concepts that are key in pretty much all federal litigation, including tax cases. First, there's the burden of proof. You hear this term a lot. In most civil cases, the person bringing the lawsuit has the burden. Well, in most civil tax cases, you, the taxpayer, have the burden of proof.
So I have to prove the IRS is wrong, not the other way around.
Generally, yes. You have to prove that the IRS's determination of how much tax you owe is incorrect. It's not up to the IRS to prove you owe more. It's up to you to prove you don't. That can be tough, and it really highlights again why keeping good records is so critical. However, and this is a big however, the burden of proof can shift to the IRS. This can happen in certain types of tax cases, like income, gift, or estate tax cases, but it only shifts if you, the taxpayer, meet some strict conditions. You have to introduce credible evidence supporting your position. You must have kept all the required books and records, and you have to have cooperated with reasonable requests from the IRS for information.
So if you've done everything right, documented everything, and cooperated.
Then the burden can slip. The IRS then has to prove its case. That's a powerful advantage if you can achieve it. But it really depends on your diligence beforehand. The second really important principle is the doctrine of stare decisis. Fancy Latin term.
Stare decisis, okay.
It basically means to stand by things decided. It's a core principle of our legal system. Judges are bound by precedent. They have to respect and follow prior decisions made by higher courts or even prior decisions from their own court when the facts or legal issues are similar. This brings consistency and predictability to the law. How a similar case was decided before heavily influences how your case might be decided. And just quickly on appeal outcomes. If a case goes to an appellate court, they can do a few things. They can affirm the lower court's decision, meaning they agree with it. They can reverse it, meaning they overturn it. Or they can remand it.
Remand. Send it back.
Exactly. Send it back to the lower court for more work, maybe with specific instructions on what to look at again.
Okay. Fascinating. So let's look at those trial courts, starting with the U.S. Tax Court. What makes it special for tax disputes? Why pick that one?
The U.S. Tax Court is unique. It's a highly specialized court that only deals with federal tax cases. Income tax, estate tax, gift tax, certain excise taxes. That's its entire focus. Its biggest advantage, the main reason many taxpayers choose it, is that you can take your case there before you pay the disputed tax.
That's the no payment required one.
That's the one. You don't have to write a check for the disputed amount first, unlike the other federal courts. That's a massive benefit if you don't have the cash sitting around to pay the IRS and then wait potentially for years to get it back if you win. In the tax court, your case is heard by a single judge. And importantly, that judge is a tax expert. They live and breathe the Internal Revenue Code.
So they really know the details.
They really do. Also, there are no jury trials in tax court. It's always a bench trial, meaning the judge decides both the facts and the law. And interestingly, you can represent yourself there, though for anything complex, getting professional help is usually a very good idea. To get into tax court, you have to file that petition, usually within 90 days of the IRS mailing that notice of deficiency, the 90-day letter. You can't go there before the IRS sends that letter. The tax court also has something called the Small Cases Division. This is for smaller disputes. If the amount of tax in question is $50,000 or less for any single tax year, you can choose this more informal route.
$50,000 or less. Okay.
Yeah. The proceedings are simpler, less formal. But the catch is, the decision is final. Neither you nor the IRS can appeal it. And it doesn't set a precedent for future cases. But it's designed to be a faster, cheaper option for taxpayers with smaller disagreements. And just in terms of the kinds of decisions they issue, the tax court has regular decisions, which usually involve new or unusual legal points, and memorandum decisions, which are more about applying existing law to specific facts. Small cases get summary opinions.
Okay, so tax court. Specialized. No prepayment needed, no jury, but a judge who knows tax law inside out.
Yeah.
What about the U.S. district courts? How are they different?
Right. U.S. district courts are the main general trial courts in the federal system. They handle all sorts of cases, civil and criminal, not just tax. Every state has at least one district court. You typically file in the one covering where you live or do business. The biggest difference from tax court: you must pay the disputed tax first, pay the full amount the IRS says you owe, then you sue the IRS for a refund.
Pay first, sue later.
Exactly. And there are deadlines for filing that refund claim, usually within 3 years of filing the return or 2 years of paying the tax, whichever is later. That pay first rule is a major hurdle for many. But here's a potential advantage of district court. You can request a jury trial.
Ah, okay. So if you want a jury.
District court is where you might get one. Unlike tax court, your case is heard by one judge who might or might not be a tax specialist. They hear all kinds of cases. So choosing district court might be strategic if you think your case would resonate better with a jury of regular people than with a specialized tax judge.
And the third option, the U.S. Court of Federal Claims. Where does that fit in?
This is another nationwide court. Its main job is hearing claims for money damages against the U.S. government. Tax refunds fit into that category. Like the district courts, you have to pay the disputed tax first and then sue for a refund.
Pay first again.
Pay first again. And also, like the tax court, there are no jury trials allowed here. It shares jurisdiction with district courts for smaller claims, under $10,000. But it often handles very large tax claims, maybe from high net worth individuals or big national or multinational companies. Its judges are very experienced in complex litigation against the government.
So once one of these trial courts, tax court, district court, or court of federal claims, makes a ruling, what happens if someone wants to appeal?
If either you or the IRS isn't happy with the trial court's decision, you can appeal to the next level. Appeals from U.S. district courts and the U.S. tax court go to the U.S. Courts of Appeals, the circuit courts. There are 13 circuits covering different geographic regions. Appeals from the U.S. Court of Federal Claims go to a specific appellate court, the U.S. Circuit Court of Appeals for the Federal Circuit in Washington, D.C. These appellate courts review the lower court's work, mainly focusing on whether the law was applied correctly. It's usually another long process.
And the final stop, the highest court.
That's the U.S. Supreme Court. 9 justices, the final level of appeal. But they are very selective. They only hear cases they choose to hear by granting what's called a writ of certiorari.
Certiorari.
Yeah.
Okay.
And they take very few cases overall and even fewer tax cases. Usually, if the Supreme Court takes a tax case, it's because different circuit courts of appeals have come to conflicting conclusions on the same legal issue, and the Supreme Court steps in to create a single nationwide rule. So while it's the ultimate appeal, getting your tax case heard there is pretty rare.
Okay, shifting gears a bit. Beyond just owing the extra tax itself, what happens if you don't comply, if you make mistakes or miss deadlines? I know the IRS has penalties, and this can sound pretty harsh. They can really add up, right?
They absolutely can. The Internal Revenue Code is full of penalties, both civil and criminal. They're not just there to punish, they're really designed to encourage people to comply voluntarily and accurately. But yeah, these penalties can significantly increase what you owe, sometimes even doubling the original tax or more. So understanding them is really key to avoiding nasty surprises. Let's start with a slightly unusual one. The Earned Income Credit Penalty. It's not a fine exactly, but a restriction. If you negligently claim the EIC, meaning you were careless in claiming it, you can be banned from claiming it for the next 2 years.
2 years without EIC just for a mistake.
Yes. And if they find your claim was fraudulent, that ban can be up to 10 years. That's a really serious consequence, especially since the EIC is meant to help lower income working families. It shows how seriously they take errors on that specific credit.
Wow. Okay, what about something maybe more common, like not paying enough tax throughout the year? I imagine that happens a lot with freelancers, gig workers, people with investment income.
It does. That's the penalty for failure to make sufficient estimated income tax payments. If you don't have enough tax withheld from your job, or if you don't make estimated tax payments on time and in sufficient amounts, and that includes self-employment tax if you're self-employed, this penalty can apply. It's calculated based on the underpayment for each period and runs from the due date for that estimated payment until your tax return due date, the regular one, not the extended one. But crucially, there are ways to avoid this penalty. These are often called safe harbors. Generally, you're safe if the total tax you owe for the year is less than $1,000, or if your withholding and estimated payments covered at least 90% of the tax shown on your current year's return, or the one many people use, if you paid at least 100% of the tax shown on your prior year's return.
The 100% of last year's tax rule, that seems simplest.
It often is. Just one catch. If
Yeah.
you're a higher income taxpayer, meaning your adjusted gross income, your AGI, last year was over $150,000, that threshold bumps up to 110% of last year's tax.
110% for higher earners. Good to know.
Right. And there's also a method called annualization of income. This helps if your income fluctuates a lot during the year. It lets you calculate payments based on when you actually earned the income. Knowing these exceptions is really important for managing cash flow and avoiding that underpayment penalty.
Okay, what about just not filing your return at all if you miss the deadline entirely?
Yeah.
How bad is that penalty?
That's the failure to file penalty. And yeah, it can be pretty significant. It's harsher than the failure to pay penalty. It's calculated as 5% of the unpaid tax for each month, or even part of a month, that the return is late.
5% per month.
Yes, up to a maximum of 25% of the unpaid tax. So if you're 5 months late filing, you could already be looking at a 25% penalty just for lateness. And there are a couple of extra kickers. If your return is more than 60 days late, there's a minimum penalty. It's the lesser of $485. That amount adjusts periodically, or 100% of the tax you owe.
Wow, 100%.
Potentially, if the tax owed is less than $485. But here's a really important point. If you don't actually owe any tax, maybe you're due a refund, then there's generally no failure to file penalty, even if you file late.
Oh, that's huge. So if you're getting a refund, filing late doesn't trigger this penalty.
Correct. This penalty is based on the tax due. No tax due, no penalty. That's a common misunderstanding. Also, if you happen to be subject to both the failure to file and the failure to pay penalties for the same period, the failure to file penalty is reduced by the amount of the failure to pay penalty. So you don't get hit with the full force of both on the same unpaid amount. And for businesses like partnerships or S-Corp, there's a penalty for filing their informational returns late. It's $235 per partner or shareholder per month for up to 12 months. That can get very expensive very fast for bigger firms.
Okay, what if you do file on time, which is good, but you just can't pay the full amount you owe by April 15th? Is there a separate penalty just for paying late?
Yes, there is. That's the failure to pay penalty. It's less harsh than failure to file, but it still adds up. It's 0.5%. That's 1/2 of the unpaid tax for each month, or part of a month, that the tax remains unpaid. Like failure to file, it also maxes out at 25% of the unpaid tax. You can usually avoid this penalty if you paid at least 90% of your tax by the original due date, April 15th, and you pay the remaining balance by the extended due date if you filed an extension. This really underscores why it's important to pay as much as you can by the original deadline, even if you get an extension to file the paperwork. The extension is for filing, not for paying.
All right, moving on to penalties related to accuracy, not just timing. What about the negligence penalty? That sounds like it's for being careless.
Exactly. This falls under the umbrella of accuracy-related penalties. Specifically, this one applies to understatements of tax that are not considered substantial. It's a 20% penalty on the part of the understatement that's due to either negligence or disregard of tax rules and regulations.
Negligence versus disregard, what's the difference?
Negligence generally means you failed to make a reasonable attempt to comply with the tax laws, basically carelessness. Disregard means you were careless, reckless, or maybe even intentionally ignored the rules. An important point here. If the IRS imposes this negligence penalty, they generally can't also stack on other accuracy-related penalties, like the substantial understatement penalty for the same chunk of underpaid tax.
Okay, so negligence is 20% for smaller, careless errors. What makes an understatement substantial for the penalty for substantial understatement of tax.
That's also a 20% penalty, but it applies when the understatement is, well, substantial. For individuals, an understatement is substantial if the amount you understated exceeds the greater of two things, either 10% of the correct tax you should have paid or $5,000.
Greater of 10% or
Yep.
$5,000.
Right. So, for example, if your correct tax liability was $40,000 and you reported tax of only $30,000, that $10,000 understatement is more than 10%. $4,000 and it's more than $5,000. So, boom, it's substantial. There's a slightly different rule if the understatement is because you overstated your qualified business income QBI deduction, then the threshold is 5% instead of 10%. For C corporations, the definition is different again, involving much larger dollar amounts like $10 million or percentages of tax. And just like the negligence penalty, if this one applies, the others generally don't get added on top for the same understatement.
Got it. Then there's the penalty for a substantial valuation misstatement. This sounds very specific, like getting the value of an asset wrong, maybe donating property or something.
That's exactly right. It's another 20% penalty, but this one applies specifically to the portion of an understatement that's due to valuing property incorrectly for tax purposes. It kicks in if the tax understatement related to the bad valuation exceeds $5,000, $10,000 for corporations. There are actually different technical standards depending on whether the valuation relates to transactions between related parties, like a parent company and its subsidiary, governed by Section 482 rules, versus transactions between unrelated parties. If it involves charitable contributions of property, you might have a defense if you can show you acted in good faith, got a qualified appraisal from a legitimate appraiser, and reasonably investigated the value yourself. And again, this penalty generally doesn't stack with the negligence or substantial understatement penalties.
Okay, and then we get to the really serious one. Fraud penalties. That sounds like it goes beyond mistakes into intentional wrongdoing. Civil and criminal implications.
Absolutely. Fraud is the most severe. And yes, there are both civil and criminal fraud penalties with very different standards of proof. For civil fraud, the penalty can be at least 75% of the portion of the understatement that's due to fraud. That's a huge jump from the 20% accuracy penalty.
75%, wow.
Yeah. To impose this, the IRS has to prove that you willfully and deliberately attempted to evade tax. The standard of proof for the IRS here is clear and convincing evidence. That's a higher standard than in most civil cases, but lower than the criminal standard. For criminal fraud, the stakes are obviously much higher. Penalties can reach $100,000 for individuals, $500,000 for corporations, and crucially, it can involve jail time, potential imprisonment. To get a criminal conviction, the government, usually the Department of Justice working with the IRS, must prove beyond a reasonable doubt that the taxpayer criminally, willfully, and deliberately attempted to evade tax.
Beyond a reasonable doubt, that's the highest standard.
It is. It's the same standard used in all criminal cases. This makes criminal tax fraud cases difficult to prosecute and usually reserved for the most blatant intentional evasion schemes.
So, on top of the tax, and on top of these potentially massive penalties, does interest get charged on the penalties themselves, too? It feels like piling on.
Unfortunately, yes, often it does. Interest generally starts accruing on many of these penalties from the due date of the tax return, including extensions. That's different from the interest on the underpaid tax itself, which usually starts from the original due date, like April 15th, regardless of extensions. So the longer a penalty goes unpaid, the more interest piles up on top of it, making the total amount owed grow even larger. It definitely adds another layer of financial pain.
Okay, so hitting about all those penalties, 20%, 75%, plus interest is definitely motivation to avoid them. How can a taxpayer proactively protect themselves? What are the best strategies to lower the risk of getting hit with these penalties, especially if you have somewhat complex or aggressive tax positions?
It really boils down to two key things: rigorous substantiation, having the proof for your claims, and proper disclosure of your tax positions when necessary. These are truly your best shields against penalties. They demonstrate you're trying to comply in good faith. Now, first, a really important warning. Don't take frivolous positions.
Frivolous, meaning completely baseless.
Exactly. Positions that have absolutely no basis in law or any established authority. Things that are clearly just wrong or are arguments repeatedly rejected by courts. If you take a frivolous position on your return, disclosing it won't help. It won't protect you or your tax preparer from penalties. The IRS has zero tolerance for these. For legitimate positions where there might be some uncertainty, the law sets out different standards. These standards dictate how confident you need to be in your position and whether you need to disclose it to avoid penalties. The lowest standard is the reasonable basis standard. This generally means your position has at least a 20% chance of succeeding if the IRS challenged it in court.
20%. That
That's
sounds not super confident.
It's not high confidence, no. It means the position is arguable, but maybe not likely to win. Now, if you have a reasonable basis for a position that leads to an understatement that's not substantial, you can generally avoid the negligence penalty without disclosing it. But if the understatement is substantial, you generally must disclose the position to potentially avoid the substantial understatement penalty, even if you have a reasonable basis. Tax shelters have even stricter rules. And importantly, you can't just claim reasonable basis if something seemed obviously too good to be true and you didn't bother to check it out. The IRS expects basic diligence. A higher standard is the substantial authority standard. This requires more support, generally viewed as needing more than a 40% chance of succeeding in court.
Okay, 40% plus. More solid ground.
Right. It means there's significant legal backing for your position, even if there might also be authorities pointing the other way. And the highest standard is the more likely than not standard. This means you need a greater than 50% chance of your position succeeding in court. This highest standard is often required for things like tax shelters, certain reportable transactions, and other areas where the IRS wants a very high level of certainty from taxpayers.
You mentioned substantial authority. When you talk about having that for a tax position, what specifically counts as authority? Is it just any article I read or advice from my accountant? Or does it have to be official IRS stuff?
This is absolutely critical and where people often get tripped up. Only specific sources count as authority for meeting that substantial authority standard. General conclusions from things like tax treatises, articles in legal or accounting journals, or even opinions written by tax professionals, while potentially helpful for understanding, do not constitute substantial authority on their own.
Wow, okay, so my accountant's opinion letter isn't enough by itself.
Not for meeting the substantial authority standard to avoid penalties, no. It can help show reasonable cause or good faith, which are other defenses, but it's not substantial authority in the technical sense. Relying solely on general advice without checking if it aligns with official sources is risky from a penalty perspective. You really need to anchor your position in the recognized official sources. So what does count as substantial authority? It's a specific list. It includes the Internal Revenue Code itself, obviously, other statutes, proposed, temporary, and final IRS regulations, revenue rulings and revenue procedures issued by the IRS, tax treaties and the regulations under them, U.S. court cases, Supreme Court, courts of appeals, district courts, tax court, Court of Federal Claims decisions, official congressional intent, like committee reports that explain legislation, the Blue Book. That's a detailed explanation of tax laws prepared by Congress's Joint Committee on Taxation, very authoritative on legislative intent.
Blue Book, never heard of that.
It's highly regarded. Also, private letter rulings, PLRs, and technical advice memoranda, TAMEs, issued by the IRS after late 1976. Certain other internal IRS documents like actions on decisions. And finally, official IRS press releases, notices, and announcements published in their official publication, the Internal Revenue Bulletin. It's a defined universe of sources that carry that weight.
That's a really important distinction. So if you do have a position that's maybe well-reasoned but uncertain or even contrary to one of those authorities, are there specific forms you file with your return to disclose it, to try and head off penalties?
Yes, absolutely. Disclosure is a key strategy when you have an uncertain position that you believe has merit. Using the right form demonstrates transparency and good faith. The main one is Form 8275, Disclosure Statement. You use this to disclose positions that might be contrary to things like IRS revenue rulings or procedures, or maybe just specific parts of the code where the application isn't totally clear. You don't use this one for positions contrary to Treasury regulations, though. The form asks for general info, a detailed explanation of your position and the authority supporting it, or why you think the contrary authority is wrong, and info about pass-through entities if relevant. For positions contrary to Treasury regulations themselves, there's a separate form, Form 8275-R, Regulation Disclosure Statement.
R for regulate.
Exactly. It looks almost identical to the 8275, but it signals you're taking a position directly against a regulation, which the IRS views a bit more seriously. And then there's Form 80-86, Reportable Transaction Disclosure Statement. This one is really crucial. It's required for certain types of transactions the IRS has identified as potentially abusive or requiring closer scrutiny. These are called reportable transactions. Any taxpayer who participates in one of these must file Form 8886 with their return. It doesn't matter if someone else involved in the deal is also filing it. Categories include things like listed transactions, specific deals the IRS has blacklisted, confidential transactions, transactions with contractual protection where you get a refund of fees if the tax benefits don't hold up, and certain large loss transactions. Failing to file Form 8886 when required carries its own set of very stiff penalties, so identifying if you're involved in a reportable transaction is paramount.
Okay, so specific forms for specific disclosures. But beyond that, are there just general defenses, overarching principles that can help someone avoid almost any penalty if the IRS does challenge something?
Yes. There's a general defense that applies across the board to most penalties. You can generally avoid a penalty if you can show three things. One, you had reasonable cause for the position or the action or lack of action that led to the understatement or failure. You had legitimate reason, weren't just guessing. Two, you acted in good faith. You genuinely tried to comply with the law and believed you were doing the right thing, no intent to deceive. And three, the issue was not due to willful neglect, meaning you didn't consciously, intentionally, or recklessly disregard your tax obligations. These three elements, reasonable cause, good faith, and no willful neglect, are often the taxpayer's strongest argument against penalties during an audit or appeal. If you can establish these, it can overcome many penalty assessments.
Okay, let's shift gears one last time to something that affects a growing number of people in our global world: foreign bank accounts. This seems like a major compliance area, FBAR reporting, and one where mistakes can be incredibly costly. What exactly is FBR, and why is it such a big deal?
FBAR. It stands for Report of Foreign Bank and Financial Accounts. And you're right, it's a critical requirement with potentially severe penalties for non-compliance. It's actually required by the Bank Secrecy Act, BSA, not directly by the tax code, though it's related to tax compliance. You file the FBI with FinCEN, that's the Financial Crimes Enforcement Network, a bureau within the Treasury Department, not with the IRS, on your tax return.
Filed with FinCEN, not IRS.
Okay. Its main purpose is to help the government track money that might be tied to illegal activities like money laundering or terrorism financing, but also to identify unreported income held in foreign accounts. So it hits both anti-crime and tax evasion concerns.
So who has to file this FBR? Is it only for people with huge offshore accounts? Or could it affect someone with, say, a small account left over from studying abroad or relatives sending money?
That's a key point. It's definitely not just for huge accounts. The threshold can catch a lot of people. A U.S. person has to file an FBAR if two conditions are met. First, they have a financial interest in or signature or other authority over any financial account located outside the United States. Second, the aggregate value, the total value of all such foreign accounts combined, exceeds $10,000 at any time during the calendar year.
Aggregate value over $10,000 at any point in the year.
It's exactly aggregate. So if you have three small accounts, maybe $4,000 in each, it's $12,000 total. Even if they were only that high for one day, you've crossed the $10,000 aggregate threshold and you have to file the FBAR reporting all those accounts. And U.S. person is defined broadly, too. It's U.S. citizens, U.S. residents, like green card holders or those meeting the substantial presence test. And also U.S. entities, corporations, partnerships, LLCs, trusts, estates formed in the U.S. financial account is also broad. It's not just bank accounts like checking and savings. It includes brokerage accounts, securities accounts, commodity futures accounts, even things like cash value life insurance or annuity policies held abroad, mutual funds held in foreign institutions. It covers a lot. And calculating that maximum aggregate value requires a specific process. You need to find the highest value each account reached during the year in its foreign currency. Then convert that maximum value to U.S. dollars using the official Treasury exchange rate for the last day of the calendar year. Add up those maximum U.S. dollar values for all your foreign accounts. If that total exceeds $10,000, you file.
Okay, so the threshold isn't huge. An account is defined broadly. The penalties for getting this wrong are notoriously severe, right? Like potentially confiscatory. How and when do you actually file the FBR?
Yes, the penalties for failing to file, especially willful failures, can be draconian, potentially exceeding the value of the account itself in some cases. Compliance is crucial. The FBR is FinCEN Form 114. It must be filed electronically through FinCEN's BSA e-filing system. No paper filing allowed anymore.
Electronically only. Good to know.
The official due date is April 15th, same as your tax return following the calendar year you're reporting. However, there's an automatic 6-month extension granted to everyone. So effectively, you have until October 15th to get it filed.
Automatic extension to October 15th.
Correct. You don't even have to ask for it for the FBAR. But remember, that's just an extension to file the FBAR form. It doesn't extend the time to pay any tax due on income earned in those accounts that taxes reported and paid with your regular Form 1040. What about jointly owned accounts? If an account is owned by, say, a married couple, do both have to file? Generally, yes. If an account is jointly owned by two or more U.S. persons, each U.S. person usually has to file their own FBAR reporting the entire maximum value of that joint account. There is a limited exception for spouses. If certain conditions are met, like they file a joint tax return and one spouse reports it fully, then only one spouse might need to file the FBAR for those jointly owned accounts. But the general rule is each U.S. owner files.
Are there any situations where you might have a foreign account but don't need to file an FBAR? Any exceptions to this seemingly broad rule?
Yes, there are a few important exceptions. They help avoid duplicate reporting in some cases. For example, if you own more than 50% of an entity and that entity files a consolidated FBAR listing its accounts, you generally don't have to file a separate FBAR for accounts owned by that entity. Also, participants and beneficiaries in U.S. IRAs and tax-qualified retirement plans, like 401k, generally don't need to file an FBAR just because the plan itself holds foreign assets. And beneficiaries of trusts usually don't have to file if the trust itself, or the trustee, who is a U.S. person, is filing an FBAR reporting the trust's foreign accounts. So there are situations where the reporting is handled elsewhere.
And finally, records. What kind of records do you need to keep for these foreign accounts, and for how long? Especially given those penalties, I bet documentation is key.
Absolutely critical. If FinCEN or the IRS asks questions, you need the proof. You must keep records for each foreign financial account reported on an FBAR for at least 5 years from the FBAR due date, which is October 15th, including the extension. These records need to include the name on the account number or designation, the name and address of the foreign bank or institution holding the account, the type of account, bank, securities, etc., and critically, records sufficient to determine the maximum value of the account during the calendar year. Having these records readily available is vital for demonstrating your compliance and supporting the figures you reported on the FBAR. Without them, defending yourself becomes incredibly difficult. Hashtag tag tag outro. So, wrapping this up, what we've really seen today is that, yes, our tax system is built on self-assessment, but underpinning that is a pretty complex and robust system. There's oversight through audits, avenues for appeal within the IRS, and ultimately recourse through the federal courts. Understanding how all these pieces fit together, how audits get started, the different penalties, the importance of backing up your numbers and disclosing uncertain positions, that knowledge really empowers you. It helps you navigate the system effectively, not fearfully. Ultimately, proactive compliance, knowing your rights at every single stage, and understanding the standards the IRS expects you to meet for your tax positions, those are your absolute best defenses.
Yeah, this deep dive really hammers home how much power there is in just knowing the rules of the game, even if the game itself seems complex. So here's something to think about. Given all this complexity, the detailed procedures, the potential for really significant penalties we talked about, from accuracy issues right up to fraud, how might a deeper understanding of these seemingly, well, dry procedures fundamentally shift how you approach managing your finances day to day, and how you prepare your tax return each year, even if you think you'll never actually face an audit? What stands out to you from today's discussion as maybe the most surprising or the most crucial piece of information for achieving genuine financial peace of mind in this whole intricate tax landscape?